Good day to all. This is the second part of translation of foreign currency financial statements. And this time we will be focusing and we will be talking just a short part of translation if ever we are in a hyperinflationary economy. So this is still using the same source. In translating foreign financial statements or foreign currency financial statements under hyperinflationary economy, we are going to use IAS 29. Now, this is not usually being used. It's because, of course, nowadays we like didn't even hear in a lot of occasions, even in simple ones, talking about cases of hyperinflationary economies or even the term hyperinflation in the ordinary course of living. Anyhow, if we say hyperinflation, inflation, remember, is the constant or the usual increase or rising of general level of prices of basic commodities. That's inflation. If that particular inflation is combined and the rates over 3 years in which such would approach or exceed 100%, then we are going to assume and we are going to concede, we can really say that an economy is suffering from hyperinflation. Inflation is but normal in ordinary economy. It's because there would be interplays of laws of demand and supply, whether we like it or not, both in terms of the goods or services and also with the money or monies available. There's also the law of demand and supply applicable to the monies available or currencies available. So in such case, it's really something that's going to happen. But approaching or exceeding 100% over 3 years, that's something that is already not normal. But then IAS 29, financial reporting in hyperinflationary economies, is made because this would at least tell the standard setters to evaluate inflation also. Remember, we often said that under our stable monetary unit concept, we do not account for changes in pesos, or we do not account for the changes in values of pesos or the purchasing power of pesos because we are actually recording historical transactions. That is true. But then if you can notice with the recent developments in the standards, there are some adjustments already made in terms of the reporting. In fact, we have the fair value measurements. In fact, we have the presentation of items on the financial statements aside from fair values into the fair market values. Then we have the net realizable values and so on, and net book values for PPE, etc. So there are already updates made, not just the historical cost as said. In fact, there's also impairment and revaluation to be able to add to such point that there are changes along the way. But it's true that in majority, we do not account for changes in the purchasing power or the inflation per se. However, again, should we reach this particular level approaching or exceeding 100%, thus there's a need for us really to look into that purchasing power changes, which really means that we do not account under stable monetary unit for the changes in purchasing power. But if this happens, we use that, or we are going to think and analyze that. Now, how do we account for hyperinflationary economies? In accounting, actually, whatever has been learned in part one in terms of translation of foreign entity financial statements in terms or in going to consolidation, that's going to be applied or still applied or applied still. But then prior to that, we have to restate whatever values in a hyperinflationary economy first into that under IAS 21. So in other words, the procedures here will be converting the financial statements of a foreign currency in a hyperinflationary economy to that as if there's no or non-hyperinflationary economy before we consolidate. All right. So in other words, these are just additional items, and that's our focus. Restatement of statement of financial position and statement of comprehensive income. Normally, these are the two items discussed. Now, under IAS 29, the non-monetary items are only the items that have to be restated because the monetary items are items already reflective of the values at the current times or in the current situation. Aside from that, their values actually do not change like over time. Whatever is the amount stated, normally that's the amount that will be received, just like cash, for example. Inventory will have to be translated, remember, at net realizable values. PPE will be at book values. Accounts payable, whatever is to be paid normally at the face will be paid at face, as well as the long-term debt. Equity, that's the exception. So cash is a monetary item. That's why whatever is the amount there, 200, after restatement, it will be the same. It is not to be changed in whatever form. But inventory and PPE, because these are non-monetary items, we have to translate. Question is, how do we translate? We have to make a factor, and the factor is this one. So we have the general price index or the GPI at the end of the reporting period. So the GPI at closing date or end of the reporting date or reporting period over the general price index at the date of acquisition. So whatever was the respective applicable rate or index at the date of acquisition of that particular item, so inventories and PPE. So it's also possible that because inventory will have like multiple items in that the rate could be somehow weighted in that sense. Okay, so to continue, we have here the year-end GPI, which would be the same. So this is like the numerator for the non-monetary items in statement of financial position as a whole, as well as the statement of comprehensive income that we will have later on. But it's another example, so it will not be using 600 as the numerator. And the denominators would be 500 and 150 respectively. So that if you can notice, because the numerator is greater than the denominator, so normally it's like a factor of multiplication. That's why 500 becomes 600 and 450 becomes 18. While here, the two items are the same. They are monetary liabilities. For the equity, here are some notes that we have to take note of. For components of equity, with the exception of revaluation surplus is part of OCI. So we can say that this is OCI as a whole, other comprehensive income. While retained earnings, a new term, of course, is accumulated profits and losses. Then they are restated by applying a general price index from the dates of the components were contributed or otherwise arose. So meaning it's 600 numerator over the general price index at the spot rates of the transactions. That's for number one. For the equity, like share capital, for example, because normally for the equity section, we have three components. Share capital, so the 600 here in this example over whatever will be the spot rates at the date of transactions. Then the issuance of shares. Second, remember we have the OCI, and third will be the accumulated profits and losses. For evaluation surplus, which is part of OCI, well, this is a basic example, we translate it into zero. OCI will become zero, while the retained earnings or accumulated profits and losses will be whatever will be the remaining balance after we have computed all assets, liabilities, and share capital, and OCI becoming zero. Okay, that is for restatement of statement of financial position. Next, for statement of comprehensive income, supposedly we are going to make use of this formula. And then it has been found out, just like we've said also in part one, that because there are plenty of transactions that affect income statement or profit or loss, as well as the comprehensive income, that is why we might be using the average price indices. So as suggested, it can be weekly or monthly depending on the transaction. In this example, actually we use like monthly. You can notice that these are the GPI or the indices for the month. This conversion factor actually is based on this formula. So GPI at the end of the reporting period over GPI at the date of acquisition. And then that's 2,880, the numerator, divided by these particular items here. So as divided, you will get these particular conversion factors. Okay, so we now have to continue whatever would be the rates or conversion factors here, and we multiply with the values for the revenue before restatement, and we get the restated revenue. So same procedure as statement of financial position restatement. Now we are going to apply the same concept or principle with this one, restatement of statement of comprehensive income, with the exception of following: depreciation and amortization, which are often easier to restate by using the formula. It is because there are only very few items that would have impact on depreciation and amortization. So we only have like few items of the PPE transactions for the year. Then deferred tax, also very few, whether assets and liabilities. Then the expenses here, of course, well, for assets and liabilities, so follow for statement of financial position. For expenses, so or income, then because there are fewer items, so we have to really use the date of transaction general price index. And we have to compute the net monetary gain or loss, which is after that. To calculate the gain or loss on the net monetary position, that is simply the difference between our monetary items here. So 560 minus 400, that's 160. Before going to that, we have to know that in theory, hyperinflation only affects the value of money and monetary items, and does not affect the value as distinct from the price of non-monetary items. So non-monetary items basically are really not affected by hyperinflation or hyperinflationary economies. Therefore, the non-monetary items just have to be restated to be able to be reflective of the current operations for the or situations. For the monetary items, normally there might be gains and losses because the amounts that will have to be considered before might be different because of the hyperinflation happening. Now, by arranging the items here, so if we divide the groups of monetary and non-monetary, then we deduct assets minus liabilities. We get net position for monetary items 160 and the non-monetary items negative 160, so that the overall net position would be zero, which is true. It is always equal to zero for the overall monetary position. Then the gain of 160 on the net monetary position should be included in profit or loss and disclosed separately. This 160 amount. All right. So that's the end of the second part. Hopefully you learned something from this session. Thank you very much and God bless us all.